Joining us now, Rockland Trust Director of Research, Doug Butler. As always, Doug, investors try to look ahead. They try to discount what they think is going to happen. And at the moment, the narrative seems to be those rate cuts are happening, maybe midway through next year. What do you think?
I think I'm with probably the 25% of the street that thinks that rate cuts will happen, but probably not until the end of the year. I think an awful lot of people have discounted the fact that there's no more raises coming. I could still see a scenario in which, again, as we head closer and closer to this soft landing, they might want to raise rates one last time. I wouldn't bet on the cuts just yet.
And so, Doug, give me that backdrop. What's your view of the equity market here, Doug? You know, you think this rally continues, and what does 2024 look like?
I think we always go into it thinking, well, we're hoping to get 10%. And, what do we think? Do we think that the market ends around 5,000 next year? Sure, that seems like a reasonable place for a tent. I don't think the ride's going to be that smooth, though. I think we could end the year next year at 5,000, up 10% or so from here. But my guess is we have some sort of 20 to 30% pullback at some point. By the way, could happen after we hit 5,000 in March, then we get the 20% pullback. But I do think that we're set up, especially that last segment where you showed the spread between bullish sentiment and bearish sentiment. I think when it's that wide, you might want to start getting your helmets on.
Yeah. So where should people be putting their helmets on, metaphorically, right? Defense, is that what it looks like right now?
Well, we're underweight in the consumer discretionary and the tech space, and that's largely because we essentially weight a lot of it based on earnings, and so the earnings for those sectors are disproportionate. The multiples for them are disproportionately high, so we generally are underweight in those sectors. But I think we're biased towards defensives and towards high quality and low volatility. Two names that have popped up for us. Accenture is a really interesting name in that they're a tertiary beneficiary of this move to AI. They're probably the best suited to help business clients move to the cloud and to more of these AI architected software. So we think that they're well positioned. And then in terms of defensives, we like Verizon. We've unfortunately liked it for quite a while, but we like it here. Particularly, we think they're getting their turnaround in place. They've improved their free cash flow a lot. They've been able to really grow this fixed wireless access business, sort of 5G in the home. We think that has some competitive advantages over the cable companies.
What about, Doug, when you look at the fixed income space, do you see opportunities there at all? Treasuries, munis, corporates?
Well, the nice part is now we've got some yield. So then now there's some benefit. The high yield spreads are pretty tight, so we probably err on being very high quality in our fixed income space. We think every client should have some high yield, but we wouldn't stretch for yield here. One of the other things is that it's the fact that the 10-year has come down. So essentially, it's now midway between where it was last month and last year. So it's above where it was last year, but in the lower mid fours is much better than 5% at the end of last month, at the end of October, Halloween rates. So it's nice that they've come down. As those come down, you'll start to see you'll see mortgage rates tick down, which will maybe improve a bit of affordability, as we don't seem to see any real weakness in the housing sector, and certainly not on the rental side just yet.
Doug Butler, thank you so much for joining us today, Doug, and have a great weekend.
You too. Bye-bye.